This is breaking financial news. Moments ago, developments have emerged that could fundamentally alter the landscape of global currency exchange, and for those watching closely, particularly anyone with an interest in emerging markets or geopolitical currency plays, this announcement regarding the Iraqi dinar is nothing short of seismic. What we are observing right now is not mere speculation. Indications are mounting that a massive shift may be on the horizon, and the implications are potentially vast. That said, we are proceeding with caution. While the information we're presenting derives from credible sources and recent official statements, it remains subject to change as the situation evolves. What follows is a comprehensive, urgent update. To frame where we stand, it's crucial to remember that for years the Iraqi dinar has been pegged to the US dollar at a fixed rate. That arrangement ensured stability for foreign investors and facilitated trade. The dinar has languished under that peg, never allowed to appreciate, even as Iraq worked to rebuild its economy in the wake of conflict. For decades, fixed exchange rate policy has limited the currency's value, and opinions have varied widely about when or if a revaluation could occur. But today, we may be at the cusp of the most consequential shift in that long-standing policy. The Central Bank of Iraq, reportedly convened an emergency meeting with top economic advisors, treasury officials, and representatives from foreign exchange bureaus. According to multiple sources, participants discussed plans to either float the dinar or at least allow a managed, gradual appreciation. They reportedly weighed the economic impact of reducing dependence on the US dollar, encouraging domestic usage of the dinar, and addressing foreign investor sentiment. Now, we must emphasize that this information is early and fluid. No official statement has appeared yet confirming a revaluation or a policy change. Yet several credible voices, including economists with knowledge of Iraq's monetary policy, regional analysts, and insiders familiar with emerging economies, have signaled that Iraq may be poised to ease its peg. One respected economic analyst noted that rising oil revenues, improved fiscal discipline, and expanding trade with non-US dollar jurisdictions could collectively reduce pressure to maintain the status quo. If correct, this would mark a strategic pivot in how Iraq manages its monetary policy, a move that, if executed, could enhance the dinar's real value in global markets. The news has already begun rattling forums, investment communities, and watchers of global currency flows. There is palpable excitement among those holding dinar positions or monitoring its prospects. At the same time, financial professionals are reminding audiences that shifts of this magnitude can be volatile. Even if the central bank proceeds, it is likely to do so cautiously, calibrating exchange rate adjustments to maintain market stability and momentum. As with any breaking economic policy, there will be winners and losers. Export-oriented sectors may face challenges if the dinar gains value over imports. Conversely, consumers and domestic industries reliant on imports could benefit from lower import costs. The broader economy could witness inflationary adjustments, shifts in capital flows, and effects on government revenue tied to oil exports priced in dollars. For international currency traders, the rumor of a revaluation may already be prompting reprice. Those monitoring the interbank rate, official daily fixing, or spot market indicators may see early flutter. Anecdotal signs suggest demand for dinar may be upticking as speculation intensifies. Whether this leads to a sustained move will depend on central bank action, market sentiment, and clear communication from Iraqi authorities. Now, let's consider what triggers could be driving this potential policy shift. Chief among them is Iraq's improving fiscal condition. Recent months have seen oil production near record levels. With global oil prices stabilizing, Iraq's revenue picture has improved. That rising revenue provides the government with more flexibility to reduce reliance on external financing and manage exchange rate policy more assertively. Simultaneously, Iraq has been expanding partnerships with regional actors, nations less tied to the dollar, including China and Iran, for trade and investment. Such diversification could reduce the burden on the dollar and support coordinated currency realignment. Additionally, the central bank may be motivated to restore credibility in inflation targeting or monetary discipline. For years, critics have argued that the fixed peg blessed complacency and masked underlying economic fragility. By allowing the dinar to appreciate, Gradually, and in a controlled manner, Iraq could signal financial sovereignty, strengthen investor trust, and better align the currency's value with economic fundamentals. That said, floating a currency comes at risk. Volatility could spike, and domestic markets might feel pressure. To mitigate that, the central bank may opt for a managed float, adjusting the rate in incremental steps, monitoring inflation, and deploying reserves if needed. As this unfolds, stakeholders worldwide are paying attention. Remittances from the Iraqi diaspora, payments for imports of goods, and the balance sheets of Iraqi banks all could be affected. Even broader regional markets may sense shifts. If Iraq, among the largest producers of oil in OPEC, moves away from dollar dependence in currency policy, might this signal to other emerging economies that a managed, diversified exchange rate regime is plausible? For now, though, nothing is official. That is where we stand. An urgent watch remains in effect as markets await any formal announcement. If the central bank confirms revaluation plans, we may see an immediate reaction in both local and forex markets. If it does not, speculation could produce short-term swings followed by calm. The tone of official communication will be critical. Any suggestion that this is early planning rather than an imminent move may temper expectations. What should audiences track closely in the coming hours or days? First, statements from the Central Bank of Iraq, especially from the governor or deputy governor, will be closely vetted. Any press release, tweet, or interview could provide clarity. Second, updates from Iraq's finance ministry or treasury officials will signal whether policy coordination is underway. Third, banks in Baghdad, Erbil, Basra, and currency exchange operators may reflect shifting prices or preparedness for a new rate. Beyond that, sensitive watchers should monitor price data for key goods, imported staples, oil revenues, consumer products. If the dinar's effective value begins changing, early signs may appear in consumer prices or import costs. For the broader financial sector, bond yields, reserve asset values, and bank liquidity positions will be telling. As of now, traders, analysts, and investors should brace for a potentially historic moment. But they must also remain realistic. The dinar market, while compelling, is illiquid relative to major currencies. Even a modest revaluation could provoke outsized market reactions. Risk management through exposure limits and scaling positions will be essential. We must also guard against misinformation. In the past, rumors of dinar revaluations have circulated for years without materializing. Worse, fraudulent claims have surfaced, false endorsements, fake press releases, manipulated websites. That history demands vigilance. This time, discussion is rooted in credible policy signals. That does not guarantee outcome, but it elevates the seriousness. If in fact the shift transpires, the effects may be far-reaching. For Iraqi citizens,